presenting a paper on the assessment of the impact of financial inclusion on economic growth. We'll do a comparative analysis between the lower income countries, the middle income countries, and upper income countries. So this is a joint paper by myself, Mrs. Gopy-Ramdhany, Professor Seetanah, and Ms. Narain. So basically, I'll do a quick introduction of the topic. So basically, we'll be looking at financial inclusion, and we've all agreed that the financial system have undergone a tremendous innovation over the last decade, over the last few years. We've seen loads of innovation, and those financial innovations have impact massively on the financial profitability, competitiveness, and sustainability of the financial system. So despite this innovation, one question that remains is, are financial system inclusive? And we could, from the prior studies, we could see that the emergence of financial inclusion became topical in the 2000s. And financial inclusion is basically what? It implies mainly a greater share of individuals having access to and using basic financial services. It is defined basically as the ease of access to the basic financial products and services in the formal financial system by the society, by different people at a point of time. So basically, financial inclusion implies an improvement in the quality of products and services offered in the financial system. And if we consider the Mauritian financial sector with the COVID-19, we've seen there have been a higher demand on more Mauritians, more people been using the mobile banking. So because of the COVID-19, because of banks being closed and so on. So there have been more demand for mobile banking, and banks nowadays are striving to provide such services. So based on these factors, to test whether the main gap we've seen is, although we've been seeing financial innovation occurring across financial system, banks, insurance, and so on, the major question remains, are financial system inclusive? So this motivates somehow this study. We would try to find out the impact of financial inclusion on the growth of economies. And we've classified, and also why financial inclusion, why this topic? Because basically, in the 2030 Sustainable Development Goal, financial inclusion is considered as a major variable. Inclusive financial system has gained recognition in the Sustainable Development Goal. So the aim of this paper would therefore be to assess the impact of financial inclusion on the economic growth of lower, middle, and upper middle income countries. So based on prior literature, we've used three proxies for financial inclusion, namely ownership, demographic outreach, and outstanding loan. So basically, account ownership would be more in terms of the financial access, financial availability, and financial usage. So when we look at the theoretical underpinnings, we won't go in depth on the main theoretical underpinnings of this study. So basically, financial inclusion we've seen has as aim enhancing the efficiency of resource allocation, enhancing the profitability of banks, resulting in higher demand for financial goods and services, higher demand for loans, and all of this would have as impact increasing investment in the economy, having multiplier effect on growth. Okay, the next theory that somehow govern the conceptual linking between financial inclusion and economic growth is with more financial inclusion, there would be more reliance on the formal sector rather than the informal sector, informal finance sector of the economy. So this higher demand, higher funds mobility in the formal sector would create a multiplier effect on economic growth. We've also another theory that could explain the link between financial inclusion and economic growth is the financial intermediation theory. So this study is based basically on these theories. A quick review of the empiricals that we have. Majority of studies have concluded that there exists the financial inclusion growth nexus is in fact a significant one. So majority of studies have concluded that financial inclusion can be considered as a driver for growth. However, there are few exceptions to this direct relationship, mainly in the Indonesian countries. The methodology that we've used is we've adopted a panel data analysis. Like here, let me explain the sample first, and then I move to the methodology. So we focus on 3 categories of country, and we've taken data from 2008 to 2019. So therefore, would be using a panel analysis, a panel data analysis. So this paper have based itself on the work of Kim, Huang al. and Nawati 2000 to assess the relationship between financial inclusion and economic growth. So our main model is highlighted here. GDP, which is a proxy for economic growth, is a function of financial access, financial availability, and financial usage. So these 3 are our proxies for financial inclusion. Financial access, we've normally taken the number of deposit accounts with commercial bank per 1,000 adults. Financial availability, we've based ourselves on the ATM per 100,000 adults, and financial usage by the outstanding loans from commercial bank. And we've also included 4 control variables, mainly the bank Z score, the non-performing loan to total gross loan, the CPI as an indicator of inflation, and the trade openness. Since we are measuring growth, and we've seen that since we are measuring the growth and I think now it will be better. Since we are measuring growth, and we've seen that a growth is a last year growth. Growth is dynamic in nature, implying that a past growth may impact on current growth. So we've modified the model and included in the model past growth into it. Okay, that's why we included in the model ln GDP T minus 1.
Yeah. Osman, you want to mute yourself, please? Thank you. Sorry, so please proceed.
The final model that would use is therefore growth would be a function of prior growth and our 3 indicators for financial inclusion plus our control variable. Based on the preliminary tests that we've carried out, mainly the unit food test and the co-integration test, the results of the preliminary test suggest that the best model would be the GMM, which is the generalized methods of movement. So the GMM have been applied, and the table here shows our main results with ln GDPC, gross domestic product, as a dependent variable. The first 2 columns here show the result for the lower middle income countries. The 2 middle columns shows for the upper middle income countries, and for the last 2 columns for the middle income countries. So interestingly, what we could see is we find that financial access, financial availability are positive in all these 3 countries, whereas financial usage is negative and significant only for the low income countries. So our main So we will be explaining the result shortly. And interestingly, what we've seen is
Big Girl, you need to mute yourself, please. Thank you.
what we've seen is the LNGDP.
I like black people.
The LNGDP coefficient is also positive and significant. So confirming that the 1 year lag value of
Dr. Dada, you're going to have to remove Nick Gore from the, pardon me, you have to remove Nick Gore from the event immediately, please. I don't have the capacity to do that. It needs to be removed immediately.
Yeah, because he's also posting pictures too, I believe.
I'm sorry?
He's posting some kind of.
Yeah, there were pictures and file. Yes, thank you, Dr. Dada.
It's a Zoom bomb. It's not related to this event at all. Sorry for the interruption. Sorry. Please proceed.
Yeah. So our research showed that the 1 year lag value of GDP is positive and significant across all the 3 sample of countries. So confirming that growth is dynamic in nature. So this implies that if a country has been achieving a relatively high rate of growth in the past year, this would impact on its economic growth. Next, what we've seen is the financial access is positive and significant, like we've seen here. The financial access is positive and significant across all 3 countries, but however, it is weaker in the lower middle income countries. So we find here in the lower middle income countries, it tends to be weaker. So this suggests similar results have been obtained by Balil and Giron 2001, and it suggests basically that account ownership does not necessarily translate into adequate deposit that will be provided as loan, implying that the financial intermediation process may not be that efficient in low-income countries as compared to middle and upper-income countries. Regarding financial availability, we've seen again it across all the 3 countries, they are positive, but however insignificant for lower income countries. For lower income countries, the coefficient is rather insignificant, okay? And regarding the financial usage, what we find here, interestingly, it is negative and significant in lower middle income countries. So it implies an financial usage is measured mainly by the outstanding loan. So basically what we've seen why that might be negative, why financial usage might negatively impact on economic growth in lower middle income countries, it's mainly because of the quality of borrowers, okay? When in low middle income countries, so probably the screening process is not as effective as upper middle and high income countries, and also the ability of borrowers to repay the loan is lower. Basically, most of the loans are taken in to finance loans in sectors that are more volatile than in upper or middle income countries. So basically, based on our research, what are some of the main recommendations we could do? We've seen that financial inclusion is an important variable. Financial inclusion do contribute to economic growth, and therefore policy makers should, if they want to get out of the poverty trap, if they want to for their economies to grow, they should somehow invest on financial inclusion. However, we've also seen that financial inclusion cannot be done by the financial system alone. We need government commitment. Regulation also is important, and very important. We need to know your clients, and money laundering policies, rules and regulation are important, as we've seen that with regard to financial usage in lower income countries, financial usage is adversely affecting growth. So this may be because of lenient regulation, because of undermining of know your client procedures, which might result in a higher level of default loan, okay? So basically, we've also seen that there is a need in low and middle income countries to place more emphasis on technology-based innovation, okay? And like we mentioned, we need innovation, but innovation should be supported by regulatory efforts. We need rules and regulation. So that's basically some of the main policy recommendations from this paper. So thank you for your attention. And if you have any questions.